All attendees are in listen-only mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 23rd, 2016. What I got on the screen is the E-mini S&P 500 futures. And I got a lot of price levels, as you can see on my screen. Let me just clean it up for you here real quick here, and then I'll give it a little bit of a clean screen. We've had this past week with the Bank of Japan and Janet Yellen coming out and giving us her recipe for blueberry pie, which is nothing but sugar and fat. Of course, everybody likes to eat a lot of things sweet and gain a little bit of weight, a lot of starch. Anyway, that's what she put on the table. Markets loved it, but a lot of analysts and a lot of experienced investors did not like it. With that dovish tone, Janet Yellen essentially said that our dot plot, which is the forward-looking potential interest rate hike, has been lowered for 2017 and 2018 by almost 50 basis points. So without a rate hike for this past session or this past week, the FOMC essentially is signaling that yes, the economy is expanding, but very slowly. Global growth is very slow. Inflation is not where we want it to be, so we can hold off on doing rates right now. And oh, by the way, we're not a political alarm. I don't think there's ever been a time in history when the Feds have raised the rates right before a presidential election here in the United States. But that's what we got right now. There is going to be one more Fed meeting before the elections. That'll be, I think, November 2nd. The markets have pretty much discounted that as a potential rate hike meeting, but the markets have pushed off till December over almost a 60% chance of a 25 basis point rate hike. And if you think about it, 25 basis points when we've been at zero for 7 or 8 years is almost nothing. So I think that the markets are, or at least the Feds, they're in my mind, the Feds are acting like market makers. They are the supreme market maker in this financial market, and they are creating these asset bubbles that at some point will bust. I'm still on record as saying that in the next 12 to 17 months, we're going to get a 25 to up to a 40% pullback. I don't know what's going to be the trigger. It could be the overinflated debt in China. It could be the European Union coming unraveled. Remember, we got in later this year, we got Italians going to the polls to vote. We got the French coming in, going to the polls and voting, and they're trying to put referendums on the ballot, much like Great Britain did, to say, do we want to leave the European Union? And it doesn't really take a vote to say we're going to leave the European Union to upset the markets. It could just take the concept of let's do a vote. And if they do put it on the referendum, it'll be just like the Brexit vote. And the markets are going to be very weary of that. So we could have a China implosion. We could have this implosion in the European Union. And then let's not forget Japan, where they also, the Bank of Japan came out and they changed their stimulus program. They're running about, what, 800 billion a year in purchasing bonds, US dollars, Japanese bonds, but now they're going to do the opposite of what the Feds did here in the US for the past 7 years in what we called Operation Twist. What they're going to do is try and twist it the other way by raising the yield curve and forcing inflation another way. They're trying another approach. So when you've got the Bank of Japan, you've got China, you got the European Union, you got Great Britain, all of them trying to continue to stimulate their economies, and you've got the Fed sitting on the sidelines not really raising rates. To me, it's a recipe for an imbalance, a big imbalance. Understand how financial markets work, folks. They work based on imbalances, and fear and greed, if you think about it, is nothing but an imbalance. Markets always overcorrect both to the upside and to the downside. And as traders, what we want to do is take advantage of these overcorrections. Most rat brain traders, which is kind of my term that I've coined for people that just follow their natural inclination of fear and greed, are always buying high and selling low, as opposed to the old axiom, buy low, sell high. But if you think about buy low and sell high, it's very, very difficult to do. When there's blood in the streets, when all the headlines and all the business journals and papers and things are saying, the markets are going to go lower and see I told you so and so forth and so forth. People don't buy and they end up selling, and then the markets go up, so you end up selling low and buying high. That's the natural inclination. That's the natural fear and greed of the markets. Now, how high can these markets go with this overstimulation globally and with the Feds on the sidelines for now? They can go a lot further and higher than you think. I've got a projection here. I had a projection post-Brexit up to 2,200, and we got up to about 2192. I missed it by 8 points. And I said that we could possibly test that again, but we're starting to see some weakness here. If you look at this chart, even though last week did finish in the green, you know, and if I draw this trend line, well, that's, you know what, rather than draw it, why not just put it on the chart? So let's just do it like this. If we were to kind of put this on the chart like that and draw this up here, this is going to be our first test somewhere down in this area right here, around the 2100 level. Should we break that, we've got the a little bit of a test right at that 2100 level, as I said. Then we got the Brexit test at 1981. And remember, we're in September, which is historically one of the worst months of the year for volatility, and outside of July as a down month. But September tends to be more volatile because everybody's back to the market. July is more of a summer time frame where the markets just kind of grind a little bit lower, but September tends to be a little bit more volatile. But remember, in the summer months, generally, the markets moved higher, right? They moved up. So we could have the opposite effect and markets move lower into the end of the year. Why? Because we've got a number of concerns out there. Primarily, Q3 earnings are coming up, okay? And analysts, as they always do, and the FOMC always does, and most central bankers, that's just their nature, they always have a rosy forecast 6 to 9 months out, and then as you approach those time frames, they start dialing back their forecast. The Feds have been doing that now almost every quarter for 8 years, all right? 8 years, almost every 3 to 6 months, they've been dialing back the forward projections of growth in economic forecast. They've done it in the ECB. China has done it. Japan has done it. Every central bank does it. Guess what corporations are doing? They've been doing it too. We've had 5 quarters of year-over-year earnings reductions in corporations. So we've been in a earnings depression, I guess, for corporations for quite some time. Yet we're near all-time highs because we've got cheap money, and money has nowhere else to go. As you probably heard the acronym, there is no alternative, TINA. There's no alternative. You got to get back into the markets, and some of these funds are required by fund charter to have money in the markets. They can't hold cash, and some funds can't hold cash because it costs money. There's over 13 trillion, maybe slightly under that, in debt or in securities, government securities that are below zero negative interest rates. So it's just it's forcing money into the equity markets, and it also it's a very clever way of creating a wider income gap. Those that have money in the markets are making money. Those that can't afford to invest in the markets don't. So it's a way to increase the income gap between the haves and the have-nots. But of course, if you hear a politician say it, they won't take the heat. They won't say it's their policies that are doing it. They'll blame it on the other party, which is just insane. But anyway, looking at the E-minis right now, you can see here that it's showing to me signs of weakness. And yeah, we could come back up to this level up here, maybe up to 2200, but I would be very careful with any kind of long position. All right, I just would. And if I were to just take these off the screen here, and I'm going to put my indicators back on the screen here, and let's just kind of come out here. You can see the 2016 open price here at 2037.75. We've got a natural support area in this shaded zone right down here, which is just slightly above the Brexit. Now, we came down, as always. We always overdo it both up and down. We went below it, but we closed right back up in this area again. And we've had this nice little move off of September, or this wasn't the Brexit, but this was a move that we had to the downside in early September, and then boom, we've moved hard back up again. Our all-time highs in the E-minis 21.91.50, but we're not near we made the all-time high back on August 23rd, okay, in the E-minis. And I believe it's just going to be a grind. We're probably, I feel we have a higher opportunity of testing 2100 than we do making new all-time highs. Now keep in mind the markets after a Fed meeting, they tend to run up on a soft report, but then about a week later, it's right back where the markets were before the report. So what would that mean for us if the markets do that? That would put us right at this level right here. You can see that the Feds, when they came out with their report, it was right in this area here, okay? And then post FOMC, we shot up, we kind of paused here like a bull flag, and then we ran up here. Now we're pulling back to that level right there. And that's where we're sitting, which is a key pivot at 21.56. I was telling our members, I said we can expect a pullback to this area, but we did finish up for the week, but we had this pullback like this. Now, the chart pattern would seem to indicate that we can go higher, possibly test the 21.91. But also, if you look at post-FOMC meetings, right here was when Janet Yellen came out and gave us her recipe for blueberry pie, and the markets loved it because it was sweet and rich, and she put whipped cream on it, and she served cold milk and whatever else you like with your blueberry pie, or some people like beer with blueberry pie. But whatever, the markets loved it. Now, but what we've seen is, and this price is right in this area here, the markets tend to come right back to where the pre-FOMC meeting price level was, which would put us at this level here. So I would not be surprised to see us here. How am I playing the markets? I'm not doing a directional bet. I'm playing a little bit of a range-bound area, a little bit north of this area and a little bit south of this area near term. Okay, that's kind of how I'm seeing this right now. There is a little bit of a market maker put in the market by the Feds, the Yellen put. It used to be a Bernanke put, now it's a Yellen put. You can see here that from the 22nd down to the 24th, we've kind of rolled over here on this 2-hour chart. That's where I see it. But let me go back to the daily here for a second. Understand, guys, that I had this level up here all the way back over here on the, right in this area here on the Brexit. But it's really been here longer than that because this came out on a weekly chart. If we look at the weekly chart here, we've got the traditional, and it followed a traditional pattern, an Elliott wave 3, 4, 5. It was traditional, and based on an Elliott wave pattern, this right here was the major resistance point, and we hit it perfectly. And the only thing that did not make this as ideal as you would like to see on an Elliott wave pattern is there's no bearish divergence in this. Typically on a 5-leg up, you get a little bit of a bearish divergence, and we would call this pattern a bed on a 5-leg up. We didn't get that. So that to me suggests that there is a Yellen put in the market that's going to limit any downside near term, probably through the end of the year. But that doesn't mean that we can't experience a little bit higher volatility. We saw a lot of vol come out of the market post FOMC, but this is kind of where we're sitting right now, guys. I would say that the markets are probably going to be relatively tight ranged, both up and down, until we get into the start of Q3 earnings. Q3 earnings are really is what's going to push this thing over these all-time highs, possibly up to 2250 area, or pull us back down to this support zone here, right around the 2100 level. Now, I will show you the NASDAQ. I think NASDAQ has gotten ahead of itself. Here's the NASDAQ futures. We made all-time highs on the NASDAQ futures on the 22nd in the middle of the week with the Janet Yellen. But look at this, guys. We have got here a really nice, again, 3, 4, 5 pattern. Elliott wave pattern. We've got, it hadn't crossed to the downside yet, but we've got a potential bed setting up on the NASDAQ 100 futures. okay? Also on the NASDAQ index. And we're at new all-time highs, which was the former dot-com bubble highs in NASDAQ. We've taken those out, and we're at new all-time highs. That would suggest we can expect some weakness going forward here, okay? If we look at a potential pullback point, it would put us right around the 47.35 area. And then we've got a couple of resistance points here before coming back into the 2016 open price of 45.9250. So this to me says selling puts above makes sense to me. And for those of you that can't trade futures, maybe another way to play it would be, let me just find it on here, IWM. I'm sorry, not IWM, the Qs, but it's going to be a similar kind of thing, right? And if I just move the Qs up here like this, you'll see that the 2016 highs. What we're going to look at going into next week could be a little bit of a choppy week. I do believe that, again, we got this 3-4-5 pattern, just like NASDAQ. We've got this potential bed setting up. And what do I mean by potential bed? That's because the MACD is not crossed yet. Okay. Once you get that cross in the MACD, it formalizes it. Again, it depends on the time frame you're looking at here. I'm looking at it daily. So, you know, maybe doing a bear put spread, an in the money or an at the money bear put spread, or setting up a out of the money butterfly with the center of the butterfly down around this area down here, 114 to 115, and or doing a calendar down in this area probably even make more sense, because the volatility is relatively low now, and you're going to be holding long Vega in a calendar. So that would be what we're going to be looking at next week in the Qs. If we look at the Russell, and we look at the Russell futures, because the small cap and NASDAQ have really taken off, okay, and they've really done well. And if we look at the Russell futures, you can see here, not quite, but we came up and had a test, a double test. We could probably just pass this just in spite of it, because market makers love to just make new records and then pull back. But I'd be more interested in shorting the Russell, the Russell futures, as well as IWM. It looks the same way, right? We've got new 2016 all-time highs. We got this divergence setting up here. So shorting the Qs or shorting NASDAQ, shorting the Russell, selling bear put spreads at the money, or doing some out of the money calendars makes sense to me in those kinds of assets, okay? That's the way we're going to be looking at it. If we look at the VIX, right here, you can see the VIX has come down and given it all up, right? I mean, we were in zone 2, now we're in zone 1 in the VIX. In zone 1, the way we classify it with our group and what I work with my folks on, especially in our one-on-one sessions, is depending on what zone you're in, it kind of changes some of your option strategy and your option methodology. And what you may want to do as far as hedging with your stocks, right? If you're a stock player and you just need to be able to use options to build a barricade or a picket fence around your stock portfolio. But now we're back down here almost near the 2016 lows in the VIX. I mean, the VIX on Friday closed at 1229, and it wasn't but just, oh my goodness, September the 12th, what, about 12 days ago, almost a week and a half, the VIX was at 20, and it's given up almost half the value, not quite half, about 70% of the value or so in just a couple of weeks. So I would expect VIX probably to languish down here for a little bit, but then probably go right back up into zone 2 again. Okay, and these are percent capital deployed based on certain strategies we use based on where the VIX is. By the way, if you're not a member of our group, I highly encourage you to come in, because we're having a lot of fun this year, and we just closed out another nice week, and we're going to be doing more stuff coming up. There's some good opportunities coming up here. If we look, and there's some other stocks that we're looking at right now too, but I like playing some of these indexes, because quite frankly, they've been, low-hanging fruit types of trades. If we look at the bond market, and if we see in the bond market here, you can see we've been in this stealth mood. It's been a down move, a bearish move, right, in the bond market. And we go from the bottom of the channel to the top, to the bottom, back to the top, back to the bottom again. And I said down in this area, I wouldn't be surprised to see us come back in the middle. And if we do come back in the middle here like that, I'm going to like it because I'm going to be more interested in picking up another short. Remember, we can have the bonds going down and equities going down at the same time, okay? A lot of driver of this move here was because of what Mario Draghi has done, and we've seen some of the yields in Europe come off of their negative rates, or at least lower negative rates, to almost flatline, maybe just a 1 basis point or 2 above it. And that's caused some of the money to come out of the bond market back into Europe or into Japan. But we've seen this stimulus, or lack thereof, has put a little bit of an oomph back to the upside here. But I do believe that if bonds goes up a little bit more, I'm going to be willing to short bonds. To me, it's going to be a really good play. We've been playing TBT to the upside, which is essentially your long interest rates. Okay. Now, granted, we've got a very low curve for projected interest rate hikes, but I believe inflation is going to catch everybody off guard. We're already seeing signs of it with rising commodities. So I just think that's just going to continue to grow. And if we look at currencies, and if we look at the dollar here, because the dollar is going to be really interesting. Remember, the dollar is nothing more than a basket of a relationship of 6 other currencies. And if we look at the dollar, we're coming to a little bit of a I think a momentary kind of thing here where we're going to have to make a decision here. Again, this is a daily chart, and this goes back to the summer right here, right, on which way we go. Now, we entered this from the downside. So when you get a symmetrical triangle like this, and you enter, generally the direction that you come into this triangle is the direction you pick up and continue exiting the triangle. So that would suggest a downward move like that, and the distance of that downward movement would be roughly this distance right here, which would put us back down, testing this pivot low right down in this area here, which is around 92. Okay, that would be the technical pattern and what the technical chart suggests. Let's see if this thing breaks. If this thing does break, then going short the dollar would make some sense to me, or the dollar index. Now, the other one that we've been playing short term basically has been the pound. I think the pound, I'm still sticking to, I do believe the pound's going to come down and break this 2016 low price and come down around here, because there's still a lot of unknowns out there. But I think longer term, the pound is going to be great to the long side. So there's going to be opportunities in that as well. The yen, no matter what the Bank of Japan does, the yen just will not go down. Remember, the Bank of Japan is trying to weaken the yen, not strengthen it. But the yen is also a reserve currency for the globe in times of stress, and money is coming in there. And we're near the 2016 highs. The yen's up almost 18% year to date. And that is not good for the Bank of Japan. So let's see if they can get it down. I do believe that this will be a hard nut to crack here up at the 101 area on the yen. So to me, FXY doing out of the money bear call spreads, or maybe a deeper in the money bull or bear put spread makes some sense in the yen to me. Okay. Gold is very interesting. There is no inflation. We're not going to see 2,000 gold until we get inflation back in the market. Now, gold just reacted to the upside because there's no interest rate hike now. But we're in this tight range. I would suspect gold, the odds near term to break to the downside, and if we can get a little bit lower, then I'll be more interested in going long gold a little bit longer term. But near term, I think it's neutral to slightly bearish. And then, of course, if we look at oil, well, you guys know my position on oil. I was hoping we'd get up here, but I'm bearish oil. I think oil is going to come back down below the 40 level, probably test this pivot low right here, which is at 39.19, come down and challenge the 2016 open price of 37.60. And you know, kind of hover down here before we start making a new high again. or not a new high, but start rolling back up again. So we've been selling calls in the gold market. I mean, shit, in the oil market. We've been selling calls above the market in the futures. And I continue, I support that. I think that's a good play there. Nat gas, we're in the seasonal period where nat gas is very strong. However, now I'm looking at possibly doing shorts in natural gas. Again, we've got that same pattern at 3, 4, 5. And understand natural gas does not go in the same direction as oil or gasoline. But we've got this 3, 4, 5 pattern, boom, boom, boom. We've got this pattern right here, which is more of a bearish divergence. It triggered on Friday, so we got a bet in this. So, you know, you can play UNG to the downside, but UNG is a cheap stock. I wish they'd do a reverse split. It's somewhere in the what is UNG? It's like 8.69. So there's not much you can do with 8.69 from a stock perspective. Nat gas futures is a better way to play it if you can trade options on futures. Again, selling calls way out of the money here to me. We're getting ready to go into a period where natural gas seasonality leading up to the fall, nat gas is strong, and then when you're in the winter months, nat gas falls. So this is kind of, to me, a more natural seasonal play with natural gas. So that's what I would look at for natural gas. For the ag market, everybody is low right now. And I've favored selling puts out of the money in corn, wheat, and soybeans. I think it can go a little bit lower, but there's a limit to where it's going to go. Selling puts down in this area down here, I wouldn't mind owning corn at this level because I'll tell you, it would be a good buy because corn, wheat, and soybeans all tend to go together. And you can see just this big drop off here. And corn hit a 2016 high in June, and we're now approaching 2016 lows. So, you know, the summer months have not been good for these guys. Meats, same thing. Meats are at lows. Traditionally, the summertime is bullish for meats. But we've seen here's live cattle down to the downside. We're coming back down to 2016 lows. Feeder cattle, again, same thing. We're down around 2016 lows down here. And then if you have lean hogs, again, we're down to lows. All meats are down. I love imbalances in the commodity market because they do shift and they do change. Right now, the meats are at 2016 lows. They're very low, quite frankly. Normally, the summertime is the seasonal time for bullishness in the meat market, and the winter time is the seasonal time for more bearish. So I am not interested in doing a bullish trade right now in the meat market, but we're going to look at this for a longer-term bull because I think there's going to be some things out there. Meanwhile, in the OJ space, orange juice futures, we're near 2016 highs. And if I put it on a weekly chart, you'll see just how extreme we've gotten here. You can see here with the OJ, if I were to put, let's just put a shaded zone in the all-time highs, we're nearing all-time highs for OJ, period. Okay? All-time highs was the top of this zone right here, right in that area right there. And it didn't last very long. So 226. Now, typically what drives a commodity like this to an all-time high or an all-time low? All-time lows and overabundance in inventory and supply levels. But all-time highs, you typically have a diseased crop, or in this case, orange juice. You've got a little bit of a combination of disease crop and potential hurricane season. But understand what happens when you get to these extremes like this. Generally, when you get up to these extremes right here, they don't last too long, and then they go for a tailspin, right? So when I say too long, it can last 6 weeks. So we could be up in this area here, and then boom, we're going to come back down to that area again. So I'm already in a short in the OJ market, and it's like standing in front of a train because you can just, you know, you need to be able to, if you do futures, you need to be able to set stops above those highs right there. Okay, because that's what I'm looking for. I don't know when it's going to happen, but when it triggers, we'll see it, and then we'll take advantage of it. So that's OJ. The other one that's really got an extension here is sugar, and there is an abundance of sugar in the market. You can see here on this weekly chart, we're at 2016 highs. Right here, we've just had this huge explosion off the to the upside here. And if we look at our a close-up of this, you can see we're setting up for, to me, taking some shorts in the sugar market at these levels. To me, makes sense because I can see sugar coming back down into the 20 level and kind of sitting here and resting, possibly making another run up again, and then we're going to really crater after that. So this is kind of where we're sitting, guys. I went through this fairly quickly, but I wanted to just kind of give you a view of the equity markets via the NASDAQ, the Russell, and the E-minis. I want to give you a little bit of a view of volatility, and then in the commodity market, I wanted to talk a little bit about the ag market, the energy market, the precious metals with gold, and then the meat market, and then the softs with OJ and sugar, and then we talked briefly about the treasury market with bonds. So this was a very quick update for those, or very fast rather. For those of you that are interested in joining our group, we get folks coming in from North American markets, European markets, Latin American markets, Asian markets, Australian markets. I've got members coming in all over because we look at the market globally, not in a teaspoon view of just, let's just trade Amazon, or let's just trade Netflix, or let's just trade Facebook. And there are some good trades there, but I like to take a look at a macro view and then set up some trades and make some plays there. I think the odds favor us in doing that. So anyway, that's kind of where we are. I want you guys to have a really great weekend. We've got one more week, and then we wrap up September, and then within the next 10 days or so, we're going to kick off Q3 earnings. So I think the markets will be a little bit choppy, but they're not going to go too far to the downside, too far to the upside until we get into these earnings as a reason to start moving again. Okay, everybody, I will see our members tomorrow night. We'll spend a little bit more time on some of these markets and some of the trades that could be setting up. We also shut down a really good trade this past week. We'll be putting another one on similar to that one on Monday. All right, everybody, have a great day. Have a great weekend. Catch you guys later. Ciao.